Hello and welcome, and thank you for attending another webinar in this series that are kind of under the title of Trading in the New Economy. And we'll talk about that in just a bit, but the title of tonight's webinar is Long-Term Trading Opportunities. You have my email there if you're interested in asking any questions aside from the questions you asked tonight. And then also you have dailyforextradingedge.com, the education site for Interbank FX, where myself and a number of other contributors post their daily market commentary. So a wealth of information can be found there. My name is Brian. Thank you again for attending. As always, your questions are welcome throughout the broadcast. Don't save them for the end. I'll try and check back here and there as I have a pause or switch from the PowerPoint slides over to some of the charts and make sure that I look for any questions that you may have. So again, thank you. Let's go ahead and get started. And as always, before we jump into things, let's just leave this disclaimer up there, understanding that everything tonight is for educational purposes only. No buy, hold, or sell recommendations exist in this webinar this evening, and also that you are trading a highly leveraged product, and that trading without discipline in a trading plan obviously can be very dangerous. Okay, you've all seen that before, but again, I like to highlight it because of obviously the dangers of trading without a plan in what can be a highly volatile and obviously a leveraged market. So tonight's agenda or outline, I always like to let you know where we're going. A quick catch-up of the fundamental analysis, and you can refer back to the most previous webinar that I posted and that I did 2 weeks ago on the Q1 catch-up that covered January, February, March, and kind of a look ahead of where we're going. So you can get a little bit more detail on the fundamental analysis by looking at that, and then obviously, like I said, paying attention to the market commentary every day on Daily Forex Trading Edge. And I'll give you even another way to stay on top of that information that Interbank FX provides. But we'll talk about that briefly, go into technical analysis, and obviously tonight's outline, long-term trading opportunities, will be very technical data or technically driven data. So we'll spend most of our time in the charts. We'll look at the big picture charting and show you how I do that, and then narrowing it down hopefully to finding a good trading opportunity that may have a high probability, or at least an area where your risk reward is in the proper range, so that we're not trading with a backwards risk reward. But again, that's why we use stops and we use trading plans, because there aren't any guarantees out there. We'll talk quickly about your opportunity to get some additional help, and then we will go ahead and run through a review of the evening. So fundamental analysis, discussion of current events and what they mean for traders and investors. One way to do that is right through Interbank FX, through their website, and going to Forex Factory. Another way is to follow along on CNBC or some kind of television station that does, in your region of the world, that does focus on the financial markets. And then also you can stream it online through Bloomberg.com, and they do have a television stream as well. And then obviously you know that Interbank FX provides information and content, educational content like we're doing tonight. So your broker provides information. Obviously the internet in general provides some great information. So we're going to jump just really quickly into the Forex Factory. I already have it pulled up. Instead of going through the Interbank FX website, I have it already pulled up. And this is just your economic calendar. If you're not paying attention to this information, you should be, because a lot of it has to do with intervention around the world. Central banks from around the world are talking, such as Federal Chairman Bernanke here in the United States, or you have the European Central Bank leaders talking, or the Bank of England talking, or the Bank of Japan. It's pretty big stuff. I call them the biggest traders in the world. So if they're the biggest traders in the world and we're trying to catch a few pips, then we should be listening to what they have to say. One fun event to look at that we get every week that is looking at the U.S. jobs data. And if you haven't been paying attention to the U.S. jobs picture, things changed as of last Friday with our big report, but every week we get unemployment claims, a number of new people filing for unemployment help. So we want to see if that number starts to trend back up. So that's something to keep an eye out. So that's probably the next biggest data event to come out. Will be tomorrow morning in the United States equity session, just before the United States equity session. So paying attention to the economic calendar and to the speakers and to announcements and to austerity measures and intervention, that's a very, very important thing to do. So please continue to do that. Also, with the economic calendar showing us some change in that jobs report and showing us some change out of different bond auctions and things like that in Europe, the equity markets have been quite volatile over the past few days, where the Forex markets haven't followed their lead. And so that's what we'll talk about, is some of these intermarket relationships, and talk about some of these relationships that we use to trade. And sometimes those relationships aren't in play, and they may cause us to not trade or trade differently than we normally do. But that all goes into our trading plan. All right, let's go into back into the slides. So we covered fundamental analysis, just talking about some major events. Like I said, jobs data, which we can get an update tomorrow morning. That's obviously something people are focusing on, but also the different austerity measures around the world coming from central banks, and then also interest rates and following bond auctions and things like that that just happened in Europe earlier this week. Technical analysis, what are the traders doing with the fundamental news? Major trends, support, and resistance, live market examples. So I just want to start really quickly with jumping into the equity markets, because I always provide this relationship. And over the past 3 years, 2009, 2010, 2011, we know that the markets have gone up and up and up as far as the equity markets go. So what we can do is go ahead and look at a little bit longer term time frame as this updates. And here's what I'm talking about. 2009, I'm going to put the crosshairs on up here. All of 2009 we went up, 2010 we went up, 2011 sideways, and then 2012 we've gone up so far. The S&P actually returned 12% in one quarter in 2009, or just about 12%. It had a very good first quarter of the year, January, February, and March, and that's what I talked about at in the quarter one review. But since then, some of the economic data has come in a little bit soft, like the jobs data and some bond data and interest rates and things like that, and the equity markets have dipped a little bit. So in the big scheme of things, long-term trading opportunities, we're going down very small amounts. So by no means can we say, oh wow, the markets are really coming off. What a great deal on the global equity markets. They're so cheap. As of late, they've been cheap because they very rarely go down, and then boom, they go back up. Part of that might be because of the Federal Reserve and these austerity measures. But overall, if you're saying, hey, things are a good deal, that's all in relationship to how far we have come in such a short period of time. In 3 years, the equity markets have moved 100%. They've gone here in the S&P 500, they've gone from about 650 to over 1,400. So they've more than doubled in 3 years. That's a very large move, obviously. But as I bring this back down to a shorter time frame so that you can see, just over the past few days and weeks, we've gone sideways, and then we've definitely had a down move. We went from 1420, 1400, 1380, 1370, 1360. So we backed off about 50 or 60 points in the S&P. Pretty nice percentage move. Now, knowing that things are starting maybe to not necessarily change, but things are at interesting levels up here, and for an uptrend to continue, and you guys should be very aware of this, for a trend to continue, we have to have higher highs and higher lows. So as we start to move up, all of the lows are going to get higher and higher and higher, and we move higher and higher and higher. So this low, there's nothing wrong with this, as long as it doesn't start to go and violate the previous lows. So as long as we hang here and eventually go higher, that's the uptrend intact. But you guys can all write down on your pieces of paper 1420 or about 1425 in the S&P, right there at 1425, the highest high that we got roughly. You want to be watching for that, and if we don't get above that, then maybe the trend starts to change. So keep that written down on your piece of paper. 1425 in the S&P 500, the big broad index in as far as the United States stock market goes. You could go to the Dow Jones and do the same thing up around in the mid-13s, but you only need one index for the most part to understand that. So we're looking for sequences and trends and fundamentals or technicals to change, and so that's why we pay attention every single day to see if anything is starting to change. Moving into the foreign currency markets, so I'm going to bring up Interbank FX and the MetaTrader 4 platform here. let's just move along, and you know now that there's a big trend going on in equities and for the most part global equities. If we look at that time frame now to see what's going on, all right, a long-term time frame, this was the crash before we started to go higher. So this was the crash of 2007, 2008, and early 2009. And then when the U.S. equities rebounded, the pound, this is the pound versus U.S. dollar, the pound started to rebound. But as you can see, year after year, most of 2009, 2010, 2011, we're actually quite sideways. We're not trending like the equity markets. So the Forex markets are a little bit different for the pound versus the U.S. dollar. If I show you the euro U.S. dollar on the same exact time frame, okay, 2009, after crashing, after 2007, 2008, and early 2009, we rallied pretty hard in the euro, and then we dropped. So again, it's not really trending. It has trended up and down, but overall, it's sideways over the past 3 years. If you look at it in the beginning of 2009, right about here, it's really in the same place. It's just gone higher and lower, higher and lower. So long-term trading opportunities, we have to understand that maybe we're just in a massive big range. And so we'll talk about that in just a moment. But let me just run through a couple other pairs that are doing something a little bit different. Look at what the Australian dollar has done versus the US dollar. Here's 2009. It trended up. 2010 sideways to up. 2011 sideways. 2012. So we've been trending, but now we're maybe running out of some of that trend up here as we start to run into some resistance. So this is called a commodity currency, the Australian dollar. They export lots of gold, and they might be somewhat tied to gold prices. So just keep that in mind that we've been trending for a while. Gold prices have been trending up for a while. Gold prices have been going sideways for the past year or so, and the Australian dollar has definitely gone sideways for the last year or so. Another commodity currency, the Canadian dollar against the U.S. dollar. And again, you know that this is backwards, so it's the U.S. dollar, Canadian dollar. The U.S. dollar got weak for 2009 as the economy recovered, 2010 as the economy got better, most of 2011. And then you can see oil prices have pretty much gone sideways, and for the last year roughly, the U.S. Canadian has gone quite sideways. So these are your longer-term opportunities to now say, I know the overall trend is down in the United States dollar, but as of late it's been quite sideways. Is it going to take another dip down and continue that trend, or is it going to continue to go sideways, or is it going to turn around? What things could change that? So before we get into what things could change trends, what things could cause these pairs to trends, let's go into the main point of tonight's webinar, long-term trading opportunities, big picture charting. You don't have that many currencies to get familiar with. When you go in and trade equities or you trade options, you could have 1,000 stocks to choose from, 10,000 stocks to choose from, and most people over there in that realm, they get together a watch list. Well, most of you in the currency world probably have a watch list. A lot of us trade the majors, some currency pair crossed with US dollars. Some of us trade certain time frames of the day. Most of the volume usually goes through at the European close, US open, but some of you don't have that ability, so you might be trading in the Asian session. You might be trading the Australia versus the New Zealand, or a yen cross with another pair. So each of you is kind of an individual entity out there, an individual trader out there with your own time available to trade, time of the day, region of the world, account size, things like that. Some of you may be listening in tonight and say, you know what, long-term trading opportunities aren't even for me, because before you even go for a long-term trading opportunity, you have to remember what a long-term trading opportunity is asking you. It's asking you to be in the markets for not just a few minutes or for a few hours, but maybe for a day or 2 days or 3 days or 4 days. And as you know, a foreign currency pair can move 100 pips or 200 pips or 300 pips in a couple days, and you have to be willing to sit that out. So if you're not able to have an account size that offers you the luxury of sitting there and risking 100 or 200 or 300 pips to make 200, 300, 400, 500 pips, then maybe long-term trading opportunities aren't for you. Most people out there who are trading longer term have a larger account size, or they're trading longer term to maybe quote unquote hedge. And hedge, I don't mean hedge your currency trade. Maybe you're hedging a long-term commodity portfolio, like you hold lots of gold or silver, and you understand the intermarket relationship right here, intermarket relationship between between a commodity currency and the commodity markets. Maybe you understand what the US dollar does in relation to equity markets going up or down, and you're hedging longer term investments or your portfolio in the equity market. So when I say hedge, I don't mean hedging intra-forex, I mean hedging inter-market. So I want to make sure that that's very clear. So you don't have a lot of big picture charting to do because you have a very finite watch list. It's 5 pairs, 6 pairs, 7 pairs, 8 pairs, and you know them very well backwards and forwards. So you're familiarizing yourself with that watch list. Like I said, people that I work with that trade equities and options, I don't just let them go and search and search and search for stocks because they're always behind the 8 ball. They have a group of stocks that they follow. They're proactive because they think something is going to happen, and then they take that trading opportunity with a trading plan with stops and targets and things like that based on the charts. So use your watch list and then be able to narrow it down with a couple fundamental stories that you're going to do, and that's what I'll try and do tonight is build a fundamental story or so. Just keep in mind, some of you, like I said, may not be long-term traders tonight or finding out that you may not be long-term traders, and so some of you may say, well, I'm a short-term trader, but keep in mind, a short-term trader and a long-term trader can enter for the exact same technical reason and the exact same fundamental reason. It's just a long-term trader might have a larger stop and a larger reward because they may choose to be in it for a longer period of time than the short-term trader. A short-term trader and a long-term trader can get in at exactly the same time, and a short-term trader can be out 5 minutes later, and a long-term trader could be out 3 to 5 days later. Okay, all depending on what they were expecting to happen when they got in. So keep that in mind that we can use the same indicators, the same trading plans to get in short-term and long-term traders. So I'm just going to pause here before I go in and start to build some of these scenarios and just see if there's any questions. So the first question came in already. Will this be recorded and sent to us later? All of these webinars are recorded as long as I'm compliant and I don't give any buy, hold, or sell recommendations or say anything that's not compliant, then yes, Interbank FX will go ahead and they will review it, and then as soon as they see that it is compliant, then they will go ahead and post this to their YouTube website, and I will give you the address as we wrap up tonight where you can find more information on recordings that I've done and that other contributors to Interbank FX have recorded in the past, and there's lots and lots of videos. I probably have about 20 videos that are there. So it usually takes about 2, 3, or 4 days, and these are recorded, and you can find them on that site. And like I said, I'll give that to you. So thank you for asking that question. So like I said, please start to ask questions if you want me to look at a specific pair or whatever it may be. But thank you for that. Yeah, no problem. So let's start to build some of these fundamental stories that a long-term trader is looking for based on some of their larger term news that they're analyzing. And that's what's really, really interesting, you guys. And I can't stress this enough right now. Like I said, the equity markets have kind of been going berserk, and berserk in quotes compared to what they have been doing. They haven't been that volatile, and now they're a little bit more volatile. They can get a lot more volatile, but they've been kind of volatile as of late. And honestly, there have been some fun relationships that have been in play when the United States dollar, when the equity markets around the globe have gotten weak. For the most part, the U.S. dollar gets strong. All right, so we know by looking at this chart right here, over the past 2, 3, 4, 5 days, equity markets have gotten weaker in the U.S., and for the most part, equity markets around the world have weakened a little bit. But if you look at the past 2, 3, 4, or 5 days here in the pound, okay, so here you have these white separators for the most part, are separating days. So I'm going to blow this up. So we're looking at a handful of days here, and you can see that as the equity markets topped out last week and started to go down, and we had that bad unemployment report that actually happened on Friday when the markets were closed for Easter, for the Easter holidays. It was kind of a funky time. But the Forex markets here, the pound did drop in relationship to the U.S. dollar. But since then, the equity markets have gone down a little bit more, and you can see we've gone quite sideways here. So I can't stress this enough, and this is what I talked about in my commentary yesterday that was posted on the Daily Forex Trading Edge page. Every single currency pair, every single financial entity that you're trading, no matter what it is its own separate, unique entity, and you have to treat it like that. It's great when there's relationships in play that we can use and say, based on past performance, if this does this, this may do this, okay? May is the key word. That's why we have trading plans. But sometimes there's not always that leading market that kind of helps us and say, based on past performance, this may do this. So you can't always use that. You can't rely on that. You have to look at the pound versus the US dollar and say, here's what's happening right now. I can use past performance as a general rule, but I can't count on it every time, and things change. So based on last week's performance, the pound got weaker and the equity markets got weaker. This week, the equity markets got weaker and the pound has actually gone sideways and gotten stronger. So past performance here wasn't a good indicator. So this week, there's something different that's driving the pound to stay very, very strong in the face of equity markets being generally weaker for the most part. They went down Monday, they went down Tuesday, and then today they went up a bit. But again, that's why past performance may not be the best indicator. We have to take what we have right now and say, hey, something has changed. I'm going to make a trading plan now based on that. So as of late, look at this range here, 58 on the bottom, 58.08, 58 even roughly, all the way up to, and I've just got to move this panel here that I'm using to moderate, to 59.20. It's about 120 pips. So for whatever reason, the equity market's going down and the pound going down, they've separated from each other, and actually buying the pound down here has been the better trade. And so we're just in a huge range in the pound versus US dollar over the past 4, 5, 6 trading days. 59.25 on the top and 58 on the bottom. So longer term trading opportunities, someone may be willing to say, when it gets to 58, I might be willing to go long here, put my stop below 58, maybe at 57.50 or 57.25, risk 50 or risk 75 points, and maybe it'll turn around like it did in the past and go up 100 pips, 125 pips. I risk 50 pips to make 100 pips. I risk 75 pips to make 125, whatever it may be. That's a trading strategy using support and using your fundamental analysis and technical analysis to say, I thought that maybe the pound should get weaker, but it's not. It's holding in there. So based on that, support is telling me that maybe I can buy it here. But again, no guarantees. That's why you must always trade with stops and with targets. I can't stress that enough. So right now, we're at the top of this range. Kind of going a little bit further out and looking at the bigger picture, again, look at what we've done. This is all of this year, February and March and April moving forward, and it's kind of generally been in a big range, and the range has just kind of gotten smaller and smaller here. So what's going to get us to break out one way or the other? And that's what's so hard about the markets. That's why you can't use past performance, because every single day is changing. Austerity measures in Europe. Bank of England might come out and say something tomorrow. Ben Bernanke and the Federal Reserve in the U.S. might say we're done with quantitative easing. Every single day we have the risk of something coming out that's so big and that's so macro that can move these markets hundreds and hundreds and hundreds of pips in a certain direction. So that's what you have to be very careful with, whether you're short-term trading or long-term trading. You have to make sure that you're managing the trade day by day by day and taking new information as it comes and using that and using the charts, so fundamental analysis in conjunction with technical analysis to manage your trade very, very closely. I'll give you another trading setup in just a moment. I just want to check and see if there's any questions. So this person just read my mind. What do you think about the Australian US dollar daily trending? Okay, so fantastic, because I was actually going to go there and maybe build some kind of hypothesis out there, because that's what we're always doing as traders. We're saying, right now I have this information, and based on the charts, I'm not going to do something. Right now I have this information, and based on the charts, they're overbought or they're oversold, and I think I might do something based on my technical analysis. So let me go ahead and bring up the Australian dollar versus US dollar. Maybe some of you have never looked at it. If you've never looked at a pair and you're not familiar with it, remember that word familiarization, look at it on the long term. I understand now that the long-term trend has been up and up and up ever since 2009. We can draw a trend line kind of just following that, that up, all those lows right there being connected. And maybe, actually, if I just draw this, see, this is why these webinars are great, and this is why I love teaching. People say, why do you teach? Why do you teach? And I say, because I learn from it. So I'm just going to go ahead and delete that, because look at this, you guys. If I draw this trend line from when this move started up, and I kind of connect some of these lows, it may not come in perfect, so maybe not. So I thought that some of these lows right here might connect up, but maybe you can kind of get away with doing something like that, pretty close. So the Australian US dollar just went from 108.50 107, 106, 105, 104, 103, 102, so 102. So it came down 6.5 pennies, 650 pips. Maybe you say, based on past performance, there could be some support coming in, but I know that Brian said be careful of using the words past performance because something could change tomorrow. But if I was to take a longer-term trading opportunity, all I know is this red line has been support, and I could put in a trade to go long here, the Australian dollar, and hopefully it turns around. But remember, things could change very quickly. We don't know what may happen, so we put in our stops, we put in our targets. We don't put in our target that says it's going to 110, 120, 130. No, we look at the charts, and the charts say, I was just at 108, I came down to 102. A longer-term trader might put a stop 50, 100, 150 pips below and use this support line as support. And if it breaks it, they have a story that's saying, hey, you're wrong. This support line isn't support anymore. Get out. But if it does turn around and they're only risking 75 pips, 100 pips, 150 pips because they have a technical reason to get out, they don't have to risk 200 pips, 300 pips, 400 pips. They risk 100, 150 so and hide behind this little support line. Then if it goes up 100, 200, 300 pips, they start moving their stop up, moving their stop up, moving their stop up, moving their stop up, locking in 50 pips, locking in 75 pips, locking in 100 pips, locking 150 pips. You may use a trailing stop. You may manually, monitor it if you have the time, whatever it may be. Again, everybody's in a kind of a different trading scenario, but given what these pairs move on an average day, you've got to be willing to sit through this. So that's what I mean is today, we're on the daily right now. 102.16 was the low. Let's see. So the low was 102.25 and the high was 103.55. So it's about a little bit over 1 penny, a little bit over 100 pips. 102.25 is the low, high 103.31, so about 105 pips right there. So that's what I mean by that's the average trading range. You've got to be willing to risk at least that to sit through a day or two if you're going to try and make, have it trend your way for 2 or 3 or 4 days. So the original question, I hope I'm going to get back to answer it. What do I think about it trending? Actually, you guys, on the longer term trend, it's trending up, but now it's consolidating and trending very, very sideways, and it's kind of in the middle of its range. If you look at the top here, 109, right around 110, and if you look at the bottom down here at 97, so about a 13 pip range, it's at 102 right now. So it's 8 pips from the top, and it's about 5-6 pips from the pennies, 8 pennies from the top, and about 5 or 6 pennies from the bottom. So it's kind of in the middle of the range. So you have to ask yourself, if you're a long-term trader, why are you making a trade here short, or why are you making a trade here long? Are you making a trade because you think it's going to turn around based on this trend line that you drew? Are you thinking that it's going to go down more, so it's going to break that trend line? Maybe you're bearish commodity prices, gold prices, these intermarket relationships, whatever it may be. So given the recent trend where gold has been going down and then getting bought back up and being supported, you would think that it probably isn't the best place to get short here. Long-term trading opportunity, it's probably much safer with no guarantees to get short near the top of the resistance area. But overall, you guys know that this is a trend up, and a very popular pattern could be something like an ascending triangle where the lows are getting higher and the highs are staying in the same place, and eventually there's a reason maybe that it pops through to the top side. So that's kind of a long-term ascending triangle. Fundamentally, maybe something happens where the dollar gets weaker and commodity prices go up, or whatever it may be. There's a flight into gold, or the Australian economy continues to get better and better, and they raise interest rates 4.5%, 4.75%, 5%, 5.25% for their lending rates. And the United States dollar keeps theirs at a quarter. Well, fundamentally, that would say, hey, the Australian economy is getting better than the U.S. economy. We'd rather put our dollars, pension plans and banks and things like that, and we'd rather put our money into the Australian economy because it's doing well. So they go and buy Australian bonds, and because they have a better interest rate and they keep raising their interest rates, and that would be a fundamental event that gets it to move higher. So those are the kinds of things that we should be paying attention to. Understand the trends, understand the long-term movement, and then fundamentally say, what's my bias based on my analysis, and then look at the chart and say, hey, it just came down 6 pennies. It's sitting on a support line. Maybe I actually have some pretty good reason to go back long the Australian dollar down here and risk my 75, 100 pips to make 150, 200 pips. That could be a very, very valid trading strategy. But as you and I know, we read the disclaimer, there aren't any guarantees out there and things can change in a heartbeat. The Australian, finance minister, they could come out tomorrow and they could say, we're dropping interest rates. We're worried about our economy. That would probably not be good for the Australian dollar if they drop their interest rates. That'd be a surprise. In the markets, traders like surprises because it gets us movement, but if you're in the middle of the trade and that surprise happens, that's why you need to have stops in place and things like that. It can be very, very volatile, very, very quickly at any time, and you're trading a highly leveraged product, and trading plans are so very important to keep your trading account intact. So hopefully that answered your question on what I think, or what, looking at it and maybe seeing something where, hey, it's coming down to an area that it's more fairly valued. It definitely, to go long up at resistance doesn't make much sense because you're hoping that it breaks out, and you could be right, but obviously going back to trends, we like to buy dips in an uptrend. So the trend up, 2 steps up, 1 step down. You buy it when it steps down, 2 steps up, that's your reward. Then it goes sideways and consolidates, then up again. So obviously we're having a little bit of dip or consolidation in this overall trend. Is it going to continue up? For it to continue up and break out and make a new high, obviously there would have to be something fundamental or something big technical going on to get it there. So hopefully that was a good analysis of longer term opportunities in the Australian dollar, US dollar. Thank you. That was helpful. Okay, good. I'm glad I answered that question. So let's go back into these slides very quickly. So long-term trading opportunities, look at the big picture, get familiar with your watch list, narrow it down, build some intermarket relationships, build some familiarity with what's driving that currency pair. And like I said, some entries for long-term traders may also be short-term trading opportunities. So a short-term trader that doesn't have the account size to risk hundreds and hundreds of pips could get in here and risk 20 or 30 pips to make 50 or 60 pips. The same long-term trader might risk 150 pips to make 300 pips, but we use maybe the same trading strategy to go ahead and do that. That's what I mean by some entries for long-term traders may also be short-term trading entries. Very, very cool when that lines up. Your opportunity, if you're not sure of what type of trader you are, when you should be trading given your daily regimen and daily routine with work or wherever you are around the world, whatever it may be. This is what I do. I work with traders all around the world. I'm kind of their second set of eyes. I keep them accountable to their trading plan. I keep them disciplined. I try and work with them to teach them where decent locations are. I definitely help them build a trading repertoire, trading personality for their own individual situation. So you're the individual situation. You are the system. Until you know that, I think it can be very hard to go ahead and be profitable in these markets. So if you need any help with that, you know how to get a hold of me. I'll show you my email at the end. To review, we were able to cover fundamental events. We were able to look at the technical analysis and some of those long-term trading opportunities. Most importantly, be familiar with your watch list and be proactive. The next webinar will be on the 25th, so 2 weeks from tonight. Same thing, we'll talk about fundamentals, give you a 2-week catch-up, go into the technicals, and we're going to talk about range-bound trading opportunities based on price action. So a lot of these pairs that we saw are kind of consolidating over after the Australian dollar trended for a couple of years. It's been a year of consolidation. We saw that the pound versus US dollar has been in a consolidation for the past few months, so we're going to look at some range-bound trading opportunities. Education, like I said, use your broker, IBFX, their education platform. I post every day. I posted yesterday and today on dailyforextradingedge.com. My blog is the same information, financebanter.com, so it's the same information that you'll find on Daily Forex Trading Edge. And then the recordings. Someone had asked about the recordings. Just go to YouTube and go ahead and put in the search field Interbank FX videos, but that's it right there. You'll find about 20 of my videos there, and this one should be up there in a few days. I also post intraday market commentary. I posted there today a few times, so if you go to the IBFX Connect page, you can see me under the locals take. So I actually have that pulled up here. So here's the Connect site, ibfxconnect.com, and then login. So here's the page right there, and you can follow me under the locals take. And then here's my entry for today. I talked about drawing Fibonacci retracements in range-bound markets. So today was kind of a range-bound day, but there were some trading opportunities in that range-bound day using an indicator like Fibonacci retracements or a tool. So that's what I talked about today. So take advantage of dailyforextradingedge.com and the intraday posting at ibfxconnect.com. Getting back to the slide here, if you have any questions, like I said, I'll just jump back here to my email. That's where you can follow up with me if you have any questions. But I thank you very, very, very much for your attendance tonight. Thank you very much for the good participation and the good questions. And I look forward to seeing you inter-webinar, if you will, on the Connect site and on the market commentary. And I'll look forward to seeing you 2 weeks from tonight talking about range-bound trading opportunities. Have a great evening or morning, depending on where you are around the world, and look forward to working with you again soon.